but this one's going to go by rather fast tonight. So, don't mess up. Don't. What are you doing? What are you doing? Don't. Gotta love it. Gotta love it. So when I go live on YouTube, I forgot I gotta lower the volume because it's gonna echo. If you guys haven't already, please go to my channel, subscribe, share with your mamas and your baby mamas. If you haven't already. All right, okay, it's already muted. All right, so let's go ahead and kick off chapter 4. So a couple introduction phrases we're going to go over in chapter 4 is okay. So I realized yesterday we didn't go through the terminology, but we will today. First one, earned income. Earned income is money that you earn through wages, salary, commissions. That's going to come into how you can fund your investment accounts. First in, first out. That is when, if you pull money out of an investment account, it's going to be based off the first money put in. It's the first dollar pulled out. And I don't know anything about the pulling out part. So I got 6 kids. Right, babe? My girl's right here. Gross income. Why do they call it gross? It's because your income is never enough. It's gross. That is your money you earn before taxes. Yeah, you'd be looking at the check like, golly, government, get the hell out of my pockets. Gross income, right? Okay, last in, first out. This right here is going to be the last dollar put in is the first dollar taxed. That's going to come back into annuities. We'll come back into that. Nonprofit organizations. Obviously, I think you should know what a nonprofit organization is. Policy endowment. That is the maturity date. Remember, policy endowment on whole life is 100 years old. That's when the policy will mature. Pre-tax contribution. This is money that is contributed to your retirement accounts pre-tax. This is generally your 401k plans, your 403bs, your TSPs, jobs, the retirement accounts that you set up through your jobs. Rollover. If you leave a job, you know you have to take that money with you. It's when you roll this money over into a new account. Generally, if you roll your money over, your generally places are roll it over into your new account with your new employer, or you roll it over into another financial institution. Surrender. That is when you cancel your policy. You surrender the money and it's gone. Or you surrender the money, you cash out your policy and you leave it. Vesting. This is when participants have the right to all their benefits. If you have a job and they contribute to your 401k, there are vesting requirements. You know, most jobs have like a 3 to 5 year vesting requirement that if you leave before then, you're not going to get all the money that they help match on your account. Tax deductible. This is money that you would use, Danielle, to lower your income, your tax liability. There are retirement accounts that will allow you to put money in there to lower your tax bill. Taxable. Definition of taxable. Subject to taxable income or state and federal government tax. Tax deferred. This is when you invest money into your retirement account and it will grow, but when you go to withdraw it is when you're going to pay taxes, such as your 401k, 403b, TSPs, all those other accounts that I'm about to get into. Okay. Let's talk about third-party ownership. Oh. Third-party ownership. This is talking about life insurance policies. So most insurance policies are written when the insured and the policy owner are the same person. However, there are situations where contract is owned by someone other than the insured. These type of party contracts are called third party. It's a legal term. Again, we kind of talked about that already. If a parent owns a policy on the child, third party. If you own a policy on your parents, third party. If you own a policy on your spouse, third party. If you own a policy or your employer owns a policy on you, third party. That's pretty much that. Let's go to life settlements. Let's make sure. Okay, so this, I kind of touched on this yesterday, where there are people that will actually buy your insurance policies from you. This right here is called life settlement. This is a term where financial transactions is where the owner of the insurance policy sells the policy to a third party in a form of a compensation. I'm just going to read the example right here because it explains it. A 70-year-old person owns $1 million of coverage. He recently sold a business for $5 million. He decided he no longer needs the insurance. The cash value has $390,000, which the insurance company would give the policy owner if he cashed out. A life settlement provider may offer him $575,000 for the policy. Once it is transferred, the funds, the settlement company will assume the premiums until the insured dies, so they will receive the $1 million. Pretty straightforward how you understand that, right? Any questions on that?
Is that like JG Wentworth when they want to buy your settlements from you?
Correct. They're going to cash it out.
Yeah. Okay.
Can you sing that for us? 877 cash now. All right. So next one, the definitions of business life settlements. Let me just read this for a second so I bring myself up to speed. The term business of life settlement refers to any activity relating to the solicitation or sale of life settlement contracts to a third party who has no insurable interest. Remember, insurable interest only has to occur at the time of the application. Only at the time of the application. The term owner refers to the owner of the life insurance policy who seeks to enter the contract. The term does not include the insurance provider, a qualified institutional buyer, a financial entity, or a special purpose entity, or a related provider trust. Obviously, the insured is the person covered by the policy. Life expectancy, I think they're only going to look at someone's policy, hoping this person's going to die soon. I don't know how long that they'll want to take on that risk, but obviously they're going to give them that money. Life settlement contract establishes the terms in which the life settlement provider will pay compensation to the owner. I almost feel like I'm repeating myself. Life settlement broker is a person for compensation who solicits. Okay, so this is the salesperson or the broker that actually finds the person who's willing to sell it. This says life settlement brokers represent only the policy owners and have a fiduciary responsibility to the owners to act accordingly to the instructions and best interests. So I think they probably shopped that out, which is weird. A life settlement provider is a person other than the owner who enters a life settlement contract with the owner. Any questions on that? Nope. Okay.
Wait a minute, hold on. Okay, so the life settlement broker, since they're doing it for compensation, they're basically taking care of the premium on the settlement, right?
100%. Yeah, the new company is going to assume the new premiums.
Okay.
I mean, you pay someone $575,000, you profit the other $425,000. I'm at it. That sounds like a good investment. Okay, so I'm going to cover group insurance. So let me explain group insurance in a nutshell, and I'll go down I just want to give you the bullet points. Group insurance is owned by the employer. The employer renews the contract every year. The employees has no say-so over what happens with that policy. The employer gets what is called a master copy. They get a master copy or master policy, master contract. They make all the rules of the policy. If they want to cancel it, good luck. The employees, they receive a certificate of insurance. If you've ever sat down with a client and they say, "Oh, I got insurance through my job," okay, Wonderful. Show me your policy. They never got one. They may have received a piece of paper or a login information to see what you have, but you never have a policy. So when people have insurance through their job, it's always annually renewable term insurance, which means every year the premium is going to go up. When you enter a group policy, there is rarely any medical questions or evidence of insurability required as long as you enroll in the open enrollment period. If you enroll after the enrollment period, if you try to get coverage after the open enrollment period, you might be subject to doing a medical exam or asking medical questions. Group insurance does have a portion where because the insurance company is paying most of the money for you. That's why it's cost effective. If you leave the employer, I'm gonna just kind of skip this place and I'll come back to it. If you leave the employer, they have a conversion privilege. That conversion privilege is 31 days at termination. You want to know that. Conversion period is 31 days. You will, Mia, get to convert the policy to a permanent policy. You do not get the option to convert it to term. It is a permanent policy all the time. But when you convert it, your premium is going to go up because you're now covering all the payment. And it's going to be based off of the current age that you are. But there is no medical questions involved. So let me repeat that. If you leave the employer, you have 31 days, you convert it to a whole life, the premium is going to go up because it's going to be based off of your new age and you're covering the premiums. And you do that with no medical questions asked. That right there is called the conversion privilege. And there is one other piece right here. I'm going to forget this. If the master contract is terminated, every individual who has been in the plan for at least 5 years will be allowed to convert it themselves. So for whatever reason, if your employer goes under or they cut benefits, as long as you've been there for at least 5 years and that plan, you can convert it. This is not going to be on the exam, but most jobs only offer 1 to 5 times your salary. And then sometimes some employers will offer you to buy more coverage, but it's generally on your own dime, not theirs. Okay. Contributory versus non-contributory. You're gonna absolutely see this on the exam. This is going to define who and how many people have to contribute to the plan and who are eligible. So the employer or group sponsored plan pay all the premiums that they share with their employees. When an employer pays all the premiums, that is referred to as non-contributory. So under non-contributory, make sure you know that 100% of the employees must be eligible for the plan. So this is the one the employer is paying everything for. 100% of the employees must be eligible to participate. And when the premiums of the group policies are shared between the employer and employees, this is referred to as contributory, where the insurer will require 75% of eligible employees be included. You will definitely see those numbers on there. So just know that in your head, however you make that make sense, contributory, 75%, non-contributory, 100%. Let me know if I can move on from there.
Miguel, So when they're talking about 100% of eligible employees, that's pretty much just saying that they gotta be full-time. Is that right?
I don't know that. They don't ask that. But
Okay.
just for the sake, just use the keep it as eligible employees. They're not going to go into detail of like
Okay.
who's full time, who's part time.
Okay. I was just curious.
Yeah, I mean, but I assume so though. I assume if you're going to get benefits, you got to be full time. And I don't know if you know this, just to kind of give you an example. When someone is put on part time at their job, their benefits are generally paused. I don't know if you ever knew that. If you've ever seen that, what's that one movie with Denzel? Is it, I want to say Johnny Q. You ever seen the movie? Where his son is having a heart transplant
John
and
Q.
his employer,
John
is that
Q.
what is it called?
John
Yeah,
Q.
yeah. Where he goes from full time to part time and he's sitting down with the employer and he says, "Hold, I've been paying this plan for years." He says, "Unfortunately, your plan's been moved from this plan to that plan." He says, "There's nothing you can do." Yeah, that's how policy should work. I've only seen one company pay out a group policy, and that was a local company. If you're familiar with Venus Swimwear, that was the only company I had ever seen actually pay out a group plan. Not saying that they don't, but out of the 9 death claims I've paid out, that's the only one that I've ever seen actually the family get the money personally. All right, now let me come back over here to the top part. This right here is going to describe what does a company have to look like in order to qualify for it. So the purpose of the nature of the group cannot be created just for the purpose of getting insurance. We all can't just come together and be like, yo, we should go get some benefits just for the sake of getting insurance. So there has to be a purpose for the group to be established. The size of the group, the larger number of people in the group, the more accurate projections of future loss experience will be. That's based on the law of large numbers of similar risk. Insurance companies actually want a high turnover. And what that means is from an underwriting perspective, they want a group of steady turnover. So younger, lower risk people are coming in and the older people leaving. It's crazy when you hear that. Literally black and white. They telling us right there how they think. And group insurance is costly. It's not cheap. So because group insurance is costly to the minister, the underwriter should consider whether or not the group has the financial resources to pay the policy premiums or whether it will be able to renew the coverage. That's not going to be ever something that you have to answer, but that is something there. I don't see it in here, but let me kind of give you a couple of extra facts for you to write down. Group insurance. When you get a policy, you're not on the policy benefits. You are not obligated to have the agent's name or phone number. And that's something you want to write down for your sake because I've seen on the test. It'll say, which of the following is true except? And it'll say they must have the agent's name and phone number. And the reason you don't need that is they have that is because how many, and there's a high turnover rate in the insurance industry. So an agent will leave and imagine that agent not holding on to that account no more and they get blown up. And you got for all your questions. There's that one. And then there is one that says if an employee is covered for more than 50,000, it's taxable to the employee. So if the employee is covered for more than 50,000, it's taxable to the employee. I'm hoping we're gonna see it in here a little bit later. But just kind of make a note of that because you will see it somewhere on one of these practice exams. But that's all we need to know about group insurance, y'all. Any questions? You about to ask something, Tanisha?
Yeah, I think I had a question on the practice exam earlier. Who sells the actual group insurance? Are they like, is it one agent or are they like contracted with the company? Like, how does that work?
It would be 1 or 2 agents. It's actually, there's companies that only target companies. Yeah, there's companies that don't write personal policies. They actually target individual. They target group companies. So, but good question. Next one, retirement accounts. There's actually a huge chart here that I'm going to leave open for you guys. Give me a second. Do yourself a favor, write that out exactly like that. Jessica, you making me hungry. And she turns the camera off. Yeah, I know she's gone. So let me explain to you what you're writing here. These are the differences between qualified accounts and non-qualified. Qualified accounts are regulated by the IRS. These are generally your employer plans. So your job has a 401k. They match you. The moment you sign up for the 401k, every 2 weeks you have money coming out your account. You don't even see it. It's invested. And that money grows tax deferred. And when you sign up for that qualified account, when you decide to withdraw from it, they're going to hit you with a 10% tax penalty if you pull out before 59 and a half. I'm going to go through all this again in detail. I just want to speak this out as you're writing it out. Non-qualified accounts. These are not regulated by the IRS. They can discriminate who they give it to. Give an example, Tanisha. Let's just say you have a group of executives. They say, hey, listen, we're only going to give the board of directors a bonus. Which I'm guaranteed that happens somewhere. That is a non-qualified plan. They can discriminate who gets it. It grows tax deferred. And if you invest too much money into that account over a certain amount, that excess amount is going to be taxed. And I'll cover that more in detail. Y'all let me know when I can move on. Do you enjoy my little Jeopardy music? We're good to go. I see Jessica. If I get a couple more thumbs up, I'll move on. You good, Tanisha? All right, I see Mia. You're good to go. All right, guys, and you guys can again come back and rewatch this replay. So I want to make sure you cover that right there. Okay, so let's go through qualified retirement accounts specifically. These are generally sponsored employer plans regulated by the IRS. The reason most employers do these retirement accounts is they are tax deductions for the employer. So when an employer is giving you money through a match, they're not doing it because it's the kindness of their heart. They're doing it because the government, that's money they don't have to pay towards taxes. These plans are generally permanent. They have vesting requirements. Again, vesting requirements is a certain time period that you have to be at the employer to get all the money that they give you. They cannot discriminate who gets this account. The general formula for you to get a qualified account is you must be of the age of 21, been there for a year, and work full time. Those are generally the requirements to get into a qualified account. Okay, so let's talk about the different retirement accounts. Let me see if there's another chart down here that they give us. Okay, so all right, so I'm actually gonna tell you how to write this chart down here too. So this right here is called these are all the qualified accounts we're gonna go through. I don't know if you take a screenshot of it, you take a photo of it, you write it down individually, whatever it is you're doing, I'm gonna go through these individually and I'm gonna give you little notes to write to it. The first plan is called a KEO plan, HR10. Next to that HR10, write self-employed small business owner. Next to that, I want you to write the word tax deferred. So this account grows tax deferred. And then that when it says HR10, that stands for 10% ownership. This type of retirement account is for your small business owners, for your self-employed. Generally, when they say self-employed, is generally less than 100 employees. Then you have what is called your SEP. That means Simplified Employee Pension Plan. This is generally for small business owners, self-employed. This right here says the employer contributes only, so you cannot contribute to it. The way these are set up, that is, if you do it for one person, you have to do it for all. So the employer is the one contributing to these plans. Simple plan. What is a simple? Let me find out. Simple plan. Again, no more than 100 employees. You're going to start to see that. This account grows tax deferred. And establish employment. That's all you need to know. That's that no more than 100 employees. That works just like a 401k plan. Employer matches employees' contributions. A 401k, who does that? Any employer. Employer matches employees' accounts. Next to that, I want you to write tax deferred. Again, that money grows tax deferred. Now this one right here, 403B, also known as TSA, is also known as called tax sheltered annuity. When it says eligibility, I want you to write the word nurse, teachers, ministers, any person that works for a nonprofit organization. So Mia, in your situation, you guys had to have a 403B, right? And a 403B is nothing more than the same thing for a 401k. It means the exact same thing. It's just labeled in the IRS handbook. 403Bs for nonprofit organizations, 401ks are meant for employers. All of these accounts are tax deferred growth. Again, that means you invest the money and the money grows tax deferred. So when you pull the money out in retirement years, you'll be taxed on it then. Any questions on this? Let me know when I can move on. Where are the guys at tonight? Derek and Rob, you're so quiet. I'll let the ladies show up. Y'all don't show your faces, bro. Dang. All right. There you go. See, did I motivate Want to hop on camera with me? Nope, then motivate you
I'm
guys.
here.
What's up with y'all? I don't see your camera though. See your face.
My
You
camera.
forgot. Rob lives in the gym, bro.
My
Rob
camera
lives in the
broke.
gym, so. Sure, we'll go with that excuse. Gotcha. Nah. All right, good. So are we good to move on? Yeah, yep. Okay. Looks like we got a good unanimous. Okay. So that's all we need to know about those specific retirement accounts. Now there's one more bar we're gonna write down. Right here. Traditional versus Roth IRA. Traditional versus Roth IRA.